Hello. Apparently, I'm Alex Conrad, an adjunct professor at Alpha Partners here at the podium. I'm also a senior editor at Forbes, and I'm going to be awkwardly interviewing these three great investors to my left. So, why don't we introduce ourselves? Jody, can you tell the audience a little bit about 3L if they haven't heard about it? Picture like a long elevator, not more than that in length, yeah?
Hi, I'm Jody Kessler. I'm a partner and founding team member at 3L. 3L is an investment firm that invests in emerging growth companies. So we partner with founders across enterprise software, commerce, and technology-enabled services in building category-defining businesses in industries that have, typically lagged in their digital innovation and adoption of technology. We've invested in companies like GoPuff, Row, Encode, among others. And we're pretty focused on companies where an M&A strategy and creative financing solutions can augment organic growth. So that's a strategy that we've been leaning into pretty heavily, especially in these times, and we can go more into that later. But and I started my career at Apex Partners. Was on the operating team there, focused on digital transformation initiatives across a lot of the firm's consumer businesses. From there, I went to Columbia for my MBA, and then held a variety of operating, investing, and advising roles before joining 3L in 2017.
Great. Hey, everyone. I'm Tanzine. I'm with General Atlantic. I'm a partner there. Been at the firm for roughly 14 years or so, 2 stints. I've been back for about 6 years. I was gone for 5 years in the middle. I was there for 7 years before that. We call that the dark ages. We don't really talk about it. But General Atlantic as a whole, global growth equity firm. We've been around since 1980. We have roughly $80 billion of assets under management, deploying about $8 to $10 billion of capital a year. Similarly to Jody at 3L, we're looking for category-defining growth businesses, global mandates. We invest in all geographies. We have 17 global offices, and invest across 6 different verticals: technology, healthcare, financial services, consumer, life sciences. I know that's only 5, but we split technology into 2. We have consumer technology and enterprise technology, and that's how we get to 6. My background, most of it has been in GA, except those 5 years, but even those 5 years was growth equity investing in different platforms, and was born in Bangladesh and grew up all over the world, went to school in the Midwest, and then started my investing career soon after that.
Awesome. I'm Harley Miller. I'm the founding managing partner and CEO of Left Lane Capital. Going back a little bit, some of you might know this, but I'm sure many don't, as we're a newer player on the block. I spent my entire career predating Left Lane at Insight Partners, so about 10 years there. Insight is one of the preeminent enterprise software growth equity and private equity firms. I was really one of the lone people doing internet and consumer technology investing, an earlier stage at that, and was privileged to kind of come through the ranks there and be able to carve out my own niche or lane, so to speak. And after about a decade there, got the blessing to spin out with track record attribution and support and otherwise. And we wanted to form an institution at Left Lane that was purpose-built for internet and consumer tech, which I think is largely an afterthought for most generalist investors or enterprise software investors that might be consumer curious on any given year, which usually fades. We're based in Brooklyn. I think we're one of the few funds based in Brooklyn. We have an office in London, so we were architected to be pretty global from day one. My first deal I ever did 15 years ago was Trivago, based out of Dusseldorf. The first deal we did out of Left Lane was a Vienna, Austria-based education technology platform. So we have about 8 people on the ground in London and about 35 in New York. As an internet consumer tech investor, we feel that we can apply a growth equity playbook, but in a venture context. Why? There's a lot more data to underwrite. We have about 20 plus people scouring the world, every corner of the world for deals. We speak with probably 1,000 companies per month, and so I think we have good coverage of the internet space in the Western world. Grew up in Pittsburgh, went to UPenn, and been in Brooklyn for the last 15 years.
Awesome. Well, if we'd done this panel last year, we would have had nothing to talk about. And 2 years ago, maybe I would have gotten my own chair. So obviously, things are changing pretty fast in growth equity. Jody, how are you spending most of your time, and has kind of the way you think about opportunities changed in any sort of interesting or noticeable way in the last few months? Because obviously, everyone knows kind of the state of the macro market. We don't know what you guys are thinking at 3L.
Yeah. So I think, is this on? Yeah. So I think obviously a lot has happened in the last 24 months. I think it's been really challenging to be an entrepreneur. It's been challenging to be an investor. It's been challenging to be an LP. And it's been interesting to see sort of the conversations shift, within our portfolio, within things that we're looking at. So, at 3L, we're looking for companies that are leveraging technology, whether that's proprietary technology or whether that's bolstered by third-party tools and services, to go after really large industries that have been lagging in their adoption of technology. And where we see an opportunity now, and we're looking at this both internally at our own portfolio and then also externally in terms of what we're looking for in sourcing, is finding opportunities where you've got companies with really strong fundamentals that are at an inflection point. So they have product market fit, they have unit economics that are working, they've got a scalable, organic go-to-market motion, but where we can also leverage those platforms to start to think bigger and more broadly about how this technology can be used to really create category winners and category defining companies. And we've seen that work within our portfolio. This is a strategy that I think has worked really well in private equity, right? The M&A&O strategy is something that's tried and tested and true. We are taking that lens to kind of an emerging growth stage where I think there's been, a lot less frequent thought about, how can you use these platforms, which, are just so focused on growing and actually create real platforms and create a lot of equity value in the process. And we've seen that work across our portfolio in companies like GoPuff and Row, at Avance, where M&A has become like a really core part of the growth strategy. And then more recently with a company that, 2 weeks ago, a company that we backed since the Series A announced a $1.5 billion takeover take private of a public company in the legacy kind of parking operations space. So that company, Metropolis, was leveraging, their homegrown technology and software and payments infrastructure. They were selling into these legacy parking operations businesses, and they thought, well, we're making these businesses so much more profitable and so much more valuable. We actually want to own this and own the upside. And so we're looking at, a ton of opportunities within the portfolio. You asked how I'm spending my time. It's probably 75% with companies thinking through strategies like that. And then externally, as we're looking at new investments, it's something that we're being really mindful of and thinking a lot about.
That's interesting. For Tenzin and Harley, have you seen more M&A, or do you think that kind of these combinations or sort of more even take privates or mergers, is that something that you see at all or expect to see in your portfolios?
I think the answer is yes. I think anytime you go through, the bull market that we went through, and the level of company formation that we saw in the 2009 to 2021 period, what you're going to have is multiple different companies who are all great companies run by great entrepreneurs running after TAMs that are not necessarily unending. And at some point when the environment changes and the interest rate environment changes and the funding environment changes, a wave of consolidation will come so that you get more pricing power and you're able to sort of like have a more efficient go-to-market structure to be able to serve the TAMs and able to serve your consumers. And I think we're about to see a wave of those happening, both in the private markets and the public markets. And we're prepared for that. We're seeing that in the portfolio. And one of the first things we did when we realized that the world had changed, which I'll come back to maybe a little bit later, is that we identified across our portfolio where we have 220 companies and tried to take a level-minded approach to it, going, who are the consolidators in our portfolio and who are the consolidatees in our portfolio? And then try and adjust our strategies within our portfolio depending on which bucket you fell in. So we're going to take offense when we have portfolio companies that are platforms that could be consolidators, and when we have great companies that don't have the scale or the right business model, we're going to try and roll those into platforms as a consolidatee where the surviving entity has a better chance of success. So that's been one of the first things we did once the environment changed.
I don't have too much to add to that because we're despite our fund size, we're predominantly early stage investors. Most deals are sub $100 million entry valuation, oftentimes meaningfully less. Obviously, we take heed and pay close attention to what's going on in the public markets to inform what we do. And I think in the consumer internet world, having mergers of equals, there's a lot of dissonance up and down a capital stack or across a cap table, and so it's very rare that people can put aside ego or economic dissonance to actually make something work. And then if you're combining two bad companies, you're just left with one bad company, right? So there's a reason why HelloFresh never bought Blue Apron, because I think it would have just been a drag on what they did, and they felt like and that's something I could speak to, not in a material, non-public way. I worked with a company for 8 years and led that investment back at Insight, and you saw Blue Apron recently just get taken out, and I think that was kind of salvage value and scraps at best. And they just kept at executing, right? So I think unless there was something synergistic other than just getting rid of certain costs, I think that's a tougher exercise. I think it's more viable in software investing, right, where you might be adding on a new growth vector or a new product that you have to decide about whether you want to buy or build. But I think you'll see more of it right now, just because cost of capital is high and availability is scarce, and so people will try to join forces where they can.
So, Tenzin, I know that more growth deals are happening now than maybe 6 months ago when we saw a lot of growth investors launching podcasts, to stay busy.
Did you like the competition there, Alex? Of all the growth media?
I welcome it. I just wish they'd have me on more often, But no, for you guys at GA, obviously with a big view and a global view, have you seen certain sectors bounce back faster, or where you see kind of more deal activity? Has it shifted your focus at all from sort of a thesis perspective?
No, that's a great question. Maybe I'll start at a macro level, and I try and keep this in perspective, and I talk about it with my team and my partners all the time. I know it's been a depressing time in a lot of ways in growth equity in terms of liquidity, fundraising, value creation, but if in April 2020 someone had told me, or May 2020, that we'd be sitting towards the end of 2023 in an economy and a GDP that's growing 2 to 3%, sitting near full employment, I would take that trade-off any day of the week. So even though it feels really bad, relative to the cycle we went through in the global economy and with the population, I think we actually came out of it in a great place with a lot less damage than it could have been. Having said that, it's still been tough. It's not fun to see, when we lived our 2020 world and everything we invested in was up 4x in 3 months. Now that's actually not the case, and we kind of knew at the time that wasn't sustainable. That's not reality. It's hard to build a business. It's hard to build a business with sustainable moats. In terms of your question, Alex, what we're seeing right now, it's been quiet in the U.S. In software, as an example, or e-commerce as an example. Those are markets that have been e-commerce and software for different reasons. Software for valuation purposes, e-commerce for business model and go-to-market purposes, and sort of platform changes. But what we've seen has been, at least from a GA strategy perspective, a significant shift towards later stage profitable companies, and to something Jody mentioned earlier, with organic go-to-market motions that aren't as reliable on the consumer internet side, on Google and Facebook for customer acquisition purposes, and on the software side on hiring a ton of salespeople to be able to drive growth. And ultimately, those models that have efficient go-to-markets, either organically or through product-led motions, lead to better, more capital-efficient margins, and ultimately better valuations down the road. So that's been a strategic shift across all of our sectors in terms of what we focused on. Globally, what we've seen is a massive slowdown in China, where large investors in China, for two reasons, geopolitical reasons, as well as endemic economic reasons in terms of what's happening with the real estate sector in China and the downstream impacts of that. We've seen a massive acceleration in India for two reasons, which is the capital markets that were historically investing into China have now shifted their focus into India. The macro conditions are much better. Company formations and scaling and growth are going a lot better. IPO market's more open in India than it is anywhere else in the world.
The multiples that Indian tech companies trade at, it's wild.
It's a really tough conversation at a global IC where I will bring a US deal and I'll be like, oh, this is trading, pretty richly at like 20 times EBITDA. And our India team will bring a deal at 80 times EBITDA going, this is a discount. This is like a steal right now. And we're like, okay, a little bit of cognitive dissonance there. But what I would say is that typically through these cycles, it takes about 18 to 24 months for seller expectations on multiples to adjust. Buyers adjust really quickly because we see it in our portfolio and we see the public markets. We adjust our expectations very quickly. If you're running a company and your day-to-day job isn't to invest, and you raised a high round, and all of your peers raised a high round, and you've doubled the size of your company because you're a great operator, it's really hard for Jody or Harley or I to show up and go, you're worth like a third of what you were, even though you doubled your company. It takes a while for entrepreneurs to understand that and internalize the macro environment. we're finally starting to see a little bit of thawing and the deal flow starting to pick up. I would say my expectation is going into Q4 and Q1, you will see a lot more deals happening, but you'll probably see the best companies being able to raise rounds at not as attractive valuations. But if you're a unit economic challenge company or not a market leader, I think it's going to be a while before capital comes back to that market.
Before we move on to Harley or Jody, do you have any sort of similar perspectives or anything you want to push back on where maybe GA is not the same?
No, I think we've always been focused on trying to find companies that can scale efficiently. I think even at the earlier growth stage, I think GA is a click later than us, but looking for companies that have a scalable and sustainable model. I think when we look at companies, we're trying to underwrite to, does this round get the company to profitability? Could it get the company to profitability? And if the whole is $5 or $10 million, then maybe we can get past it. If the whole is $100 million, then it's probably not a fit for our platform.
I think there was an era where you had businesses in the food delivery space or the GoPuffs or otherwise. I don't think they could be built today. Just that there's not an availability to that capital, and if they can't make use of what they have, and sometimes you might have to shrink the business and right-size the organization to actually get to profitability. But I don't think there's an appetite, from investors to kind of, if you don't have an equity story and there's no resonance there, meaning you're a shrinking business and you're not profitable. I'm not calling out any one company in particular. I don't know that you deserve to exist, and I don't. So I actually, when you said I'm not sure if you're a category leader or unit economic challenge, that there will be capital that comes back. I don't think that actually ever happens again. And maybe we're wrong. Maybe people sort of forget their history and go back into
Look at AI.
You're probably more right than not. I think we looked 2 years ago and we felt like certain things and concede that there are instances where we were wrong, and for sure. And you back something that had crazy tailwinds that turned into headwinds, and the business ballooned its OpEx. And sure, every investor will sit here and echo, cut, and no duh, it's kind of an obvious thing. But instead we said, is what you're doing, does it make sense? We invested in a company out of Chicago called Chowbus that was a sort of a DoorDash style business for the ethnic Asian community across North America. It was flying in COVID and it was actually making money. And of course, those tailwinds turned to headwinds. And there's competition in that market from large, the DoorDashes of the world or Uber Eats, as well as sort of more similar peers. We kind of shut that business down or drove that part to break even, and spent 2 years building a point of sale software business for the ethnic Asian merchant sort of restaurant ecosystem. And that business is flying. And so I'd much rather be in a next generation Toast that has sort of nuance versus a distant number 3, number 4, unprofitable, kind of unsound economic business. So, I think everyone needs to just assess the business and, is there a willingness to invest? And that's not an obvious thing nowadays.
I'll stay with you, Harley. You're kind of unique in that you, founded your own firm. I guess it's been what, 4 years, 4 plus?
4.5 years.
Yeah, 4 plus. And a big part of investing as a VC is kind of getting the timing right with the market. I'm curious, looking back, are you glad you started when you did? And given how kind of the last few years have played out just at the macro, how has that kind of informed your firm kind of path and construction moving forward?
Yeah, we've had a lot of growth in the last 4.5 years. We're investing out of our second fund. It's a $1.4 billion fund. The first fund was $630 million. And it's not, I don't think we were looking for asset grabbing. We were ultimately looking to, certain firms will run a very concentrated portfolio. We actually do most of our deals at Series A, and we're really ownership conscious. So we want to own 20% of as many companies as we can and then position build into those. We felt like a bigger fund actually would allow for more shots on goal there. We're 42 people. So there's been a lot of, I one time had a founder recently, not a portfolio company, tell me he was frustrated with whatever was going on. And he kind of barked at me on a call and said, man, you just don't know what it's like to be a founder. I was like, what the hell are you talking about? Do you want to go ask the 42 people out there? It's and it's something I took for granted when I watched what the founders of Insight had to do over the years, where I just had to focus on a portfolio and finding the next deal and managing the whatever umpteen boards I'm on. And there are so many different hats that one needs to wear there. And I have a lot more empathy, frankly, now for founders than I ever once did. To your question specifically of, am I happy we started when we started? I don't think there was a better time to get going. We sort of locked it. We locked in our first close of our first fund. I think it was in February of 2020. And we were weeks away probably from not having a pulse. And that was vulnerable. And then LPs said, okay, if you can't prove that you can go find deals and good deals and win them and build a firm, like you're not going to raise any more capital. And I think those are some of the best deals we did. The first deal out of Vienna, Austria, I mentioned, and at a fintech company called M1 Finance out of Chicago. Those are both companies we own 20% plus of that have gone on to raise subsequent capital. I think GA probably has looked at both of those types of companies over time. And I think we never really subjugated ourselves to the euphoria that the market was experiencing, investing at 50, 100 times revenue multiples. We knew because I had suffered what felt like cost of capital felt always expensive for when I was sitting at Insight and you had really good companies, but you just had people who weren't so keen to invest in internet consumers. So we didn't participate in that euphoria in 2020 or throughout 2021. I think we were investing at multiples that were reflective of in the mid 2010s, right? And we lost or missed out on a lot of deals as a byproduct of that, but we were okay with that. And so we didn't really whipsaw ourselves and just look at like to your point, the kind of trailing 12-month public profiles and where things were trading. Now, listen, certain investors that came in at $1 billion, $2 billion, $3 billion valuations into some of our companies, like I posit that it's a pretty steep journey to enter into positive return territory for them. And so I think you might have some economic misalignment across certain cap tables, and I think that's something that every single investor needs to be mindful of, whether you're early stage or late stage or somewhere along the way. But it was a great time for team building. It was a great time to be investing into the internet consumer tech. I think it put it on the map. I think you saw a step function penetration in the sort of channel shift from an analog, offline world to a mobile first or digital first, transforming a lot of real economy industries. And I know Jody, you would appreciate that as far as 3L's vantage point. And so, but I think we're still in the early innings of that. And so, put it this way, if I were trying to spin out now and start a fund now, I think that would be pretty challenged. I think there's a lot of fatigue from the allocator community, but I think we proved that we have a place in this industry, and we kind of came on the map relatively quickly, but built a brand and are out there, and I don't take that for granted any single day.
I'm curious, Tanzeen, for when you guys meet with capital allocators who maybe do feel like just given kind of lack of a lot of exits, they're already pretty indexed towards the private sector. At the highest level, how do you guys get them excited and optimistic about the next couple of years, or about kind of wanting to be along with this startup journey, moving forward, coming out of maybe a time where they've been not feeling, maybe they feel a little exposed or a little over-indexed? Yeah.
Look, I think it's a tough environment, and I'm very empathetic to both founders and our LPs, not just our GAs and employees, but collectively the LPs into growth and venture, because you went through a period of hyper-growth in terms of everything, including our industry, where a lot of capital was raised and a lot of capital were deployed. And the challenge a lot of our LPs faced, that there was a lot of paper gains that led funds to be able to raise subsequent funds much faster than they historically had. People were able to deploy funds in 1 to 1.5 year cycle that historically would deploy at 4 to 5. Therefore, LPs had to pony up more capital much faster. They were okay doing that because from a capital allocation perspective, their private books were performing so well that it made sense in terms of the math of doing so. But when the music stops, and it stopped very aggressively, now you're left with the, quote unquote, the denominator effect that every LP is struggling with, which is now my private book is illiquid, significantly higher. I have significant commitments, and I'm not getting liquidity on the other side. And on the other side, you have investors and companies who are like, this is the worst possible market you could imagine to try and drive liquidity because the multiples are so low. And that creates a challenge for us when we're talking to LPs in terms of raising capital, LPs who are trying to allocate capital, companies who are trying to fund capital. The thing that we're fortunate with at GA is that we've been around for a long time, so any one cycle with LPs that have been with us for 40 years or 30 years or 20 years is less important. But the thing that some of the younger partners were probably not appreciative of is our senior leadership effectively had a policy that we have to return more capital than we deploy in any given year to our LPs. So through the cycle, what we did was, 2021 is a great example, we deployed the most capital we ever deployed, which was $9 to $10 billion, but we also returned $12 to $14 billion to our LPs. So when we have those conversations with our LPs now, they're like, you actually did return capital, which is great, we're very appreciative. It's still not an easy conversation to get them to give us more capital because it's a struggle for them to move. What I do strongly believe, again, and we're and venture investors. Our bias is optimistic. Otherwise, you wouldn't be a growth venture investor. Is that what we're seeing globally in terms of entrepreneurship and company formation and the underlying sort of tech trends that we're seeing? There is so much opportunity for game-changing, company-changing, world-changing companies over the next 5, 10, 15 years that I couldn't be more excited to deploy this capital through this cycle. Because the combination of flight to quality in terms of companies picking the best investors who have capital but also are the best partners for them, and a valuation environment that is reasonable doesn't come around that often. The last one that came around was probably the investments that were happening in the tech industry in 2003, 2004, 2005, one of the best vintages ever, and broadly in private equity in 2009, 10, and 11, which were also one of the best vintages that we've had. So the LPs who've been around for a long time understand that, but the fundamental issue doesn't change. Math is math. There's only so much money they have. And what's going to happen is they're going to cut allocations to a lot of managers, and they're going to consolidate around their favorite managers. And that's going to be painful for our industry.
I know we're almost out of time, but I want to close with you, Jody. What Tenzin was talking about, sources of optimism. What is making you most optimistic or excited looking ahead?
Yeah, I think one, from within the portfolio, like the conversation, I think has shifted pretty dramatically in the last 24 months, right? It went from, 12 months of, hey, cut all your costs, keep the lights on, and I think now, fortunately, a lot of our portfolio companies, which have demonstrated, incredible resiliency through this period and are now in a position of strength, and those conversations are shifting to much more strategic, like how do we think about the next months, quarters, years, where are we going to create value? And then I think, to Tanzin's point on the investing side and deploying capital into new companies, you've got a really rich early stage ecosystem, which is super vibrant, and that's going to create a ton of companies at the growth stage for us. And then on the flip side, you're going to have great companies with, maybe some upside down cap tables that if you're willing to do the work, you can get in at really good valuations. And I think, for us, we're excited about it. And I think, our LPs are also excited about that as well.
Awesome. Well, can we get a round of applause for our expert investors?